When you have a trade opportunity, there's so much more to it than just entering and exiting the trade. What about the bit in between? That's what we call trade management. There are many things you can do with a trade once it's open, but in this video we're going to focus on scaling in and scaling out. In simple terms, scaling in just means increasing your position size on a trade that you've already got open, whereas scaling out is the opposite. You're reducing the position size. So with all else being equal, this means you're either increasing or decreasing the amount that you have at risk. But there are ways that you can scale in or out without changing the amount at risk by doing things like adjusting the position of your stop loss, things like that, but that's something we'll go through in a separate video. So when you scale out of a trade, you can think of this as though you're partially closing the trade. In fact, some traders use the term partials instead of scaling out. And when you do this, you're deciding that you want to keep the trade open, but for whatever reason, you're deciding that you want to reduce the size of it. This could happen either in a profit or in a loss. So if you scale out when you're in a profit, you're banking some of that profit. And if you scale out in a loss, you're turning part of the trade from a running loss into an actual loss. You might choose to do this for risk management purposes. So maybe the riskiness of the situation has changed in some way, either because the probabilities have shifted or the potential outcomes are no longer as favorable as they were before and the expectancy of the trade has changed. So you'll scale out to reduce the risk on any future price movements. Alternatively, you might do this for trading psychology reasons. So many traders feel the urge to bank profits as soon as they have them, often due to the combination of loss aversion and the need for instant gratification. But if you just scale out part of the trade, it satisfies that need for instant gratification and might allow you to hold the rest of the trade for much longer. After all, the key to great trading is to cut your losses and let your profits run. So this can be a good way to let those profits run even further. On the other hand, if you're scaling into a trade and doing it for logical reasons, it will usually be because the opportunity has developed in some way that makes it more favorable to increase the position size. Maybe the trade has moved massively into profit and you're willing to be more aggressive by increasing the position size and sacrificing a bit more of the profit that you've already built up. Remember, a higher position size means bigger profits, but it also can mean bigger losses. Or it may also be that you've moved your stop loss closer to the current price, which means the percentage that you have at risk is now much lower. As a result, you may be able to safely increase your position size without increasing the amount that you were happy to risk for that opportunity. Now, how much you choose to scale in or scale out by will depend on the opportunity and what sort of percentage at risk you're happy to take on it. But I'd recommend taking it easy to begin with and not being overly aggressive with it. It's a really common mistake for beginner traders to get overeager and scale into profitable trades all the time until they reach the max that they can, and then eventually the market turns against them and they take a massive hit on their account. So just start off small, don't get too overeager too soon. And likewise, a typical beginner mistake is to scale into losing positions. They do this hoping they will reduce their average entry price and make it easier to get back to break even. So for example, if I have one lot open at a price of 110 and then I scale in a further one lot at a price of 100, my average price is now 105. But it also means I have now a higher amount at risk on a trade that might be going against me. So it may mean that I have a bigger loss than I would have done. So it's better not to scale into losing trades. Now, if you really want to make the most of scaling in and scaling out and to do it in a really professional way, it's important to understand trade expectancy and probabilities. In fact, that's really important for assessing good opportunities in the first place. So if you look in the description box, you'll find a link to my free trader masterclass that will explain all of that in a lot of detail for you. And if you look down there, you'll also see links to other free trading resources that will help you to progress your trading. Thanks for watching.